This video is for educational purposes only and is not professional financial advice. Do your own research before investing. Palantir, ticker PLTR. A company born in the shadows of the intelligence community, now sitting at a nearly $400 billion market cap and posting revenue growth that just crossed 92% year over year. That is not a typo. So the question we're here to answer is a simple one. Is Palantir actually capturing a massive generational market opportunity, or is this a stock that's gotten way ahead of itself? We're going to walk through the whole picture, what this business actually does and how big the market could get, the growth story that's been quietly turning into something extraordinary, the unit economics that show whether the model holds up at scale, and finally whether the valuation makes any sense at all. By the end of this, you'll have a real point of view. Let's get into it. Here's where things get interesting before we even look at a single revenue line. Palantir operates in the software infrastructure space, and the addressable market estimates for that category are genuinely staggering. Morningstar puts the total addressable market at $1.4 trillion by 2033. Grandview Research is more conservative, coming in at $738.6 billion by that same year. So even if you split the difference, you're talking about a market measured in the hundreds of billions. Now here's what makes this matter specifically for Palantir. The company generated $4.48 billion in total revenue over its most recent full year. Against even the more conservative Grandview estimate, that's less than 1% market penetration. Less than 1%. That's not a company that's run out of room. That's a company that's barely gotten started. The real question isn't whether the market is large enough to support Palantir's ambitions. It clearly is. The question is whether Palantir can actually capture a meaningful slice of it. And that brings us straight to the growth story. Something unusual is happening with Palantir's revenue growth, and I want you to really sit with this for a second. Most companies at this scale are fighting deceleration. Growth slows as the numbers get bigger, as competition intensifies, as the easy wins get picked off. Palantir is doing the opposite. The flywheel is spinning faster. Back in Q3 2022, year-over-year growth was sitting at 21.9%. Solid, but not remarkable. By Q4 2024, it had climbed to 36%. Then Q1 2025 hit 39.3%. Q2 2025 jumped to 48%. Q3 2025, 62.8%. Q4 2025, 70%. And the two most recent quarters? 84.7% and 92.8%. Revenue itself crossed $1 billion in Q2 2025, then $1.18 billion, then $1.41 billion, then $1.63 billion, and most recently $1.94 billion in a single quarter. In terms of where the money is coming from, the United States is the dominant force at $3.32 billion, with government contracts at $2.4 billion and commercial at $2.07 billion for the full year. This is not a company finding its footing, it's accelerating. Remember that acceleration we saw in the growth data? Here's where you find out if it's built on a real business or just revenue theater. Start with gross margin. In 2021, Palantir was running at 78% gross margin. 22, 78.6. 23, 80.6. 24, 80.2. 25, 82.4%. And the direction is expanding. That tells you something important about pricing power. When margins expand as revenue scales, it means the business isn't buying growth by discounting. Now, the rule of 40, a standard health check for software businesses that adds revenue growth rate to profit margin. A score above 40 is considered healthy. Palantir scored 103. That's not just above the benchmark, it's more than double it. Then there's free cash flow. The company is cash flow positive. No burn, no dilution spiral to fund operations. On revenue per employee, with 4,395 people generating the kind of revenue Palantir is now producing, the output per person is exceptional, and it's growing. That's what operational leverage looks like in practice. Which brings up an uncomfortable but necessary question. If the business model is this strong, what exactly is the market paying for it? The current price-to-sales ratio is 94.1 times. That number deserves its own conversation. That 94.1 times price-to-sales ratio I just flagged. Let's put it in context because raw multiples without history are almost meaningless. At the end of 2021, Palantir traded at 22.7 times sales. By end of 2022, it had compressed all the way to 7 times. Brutal. 23 saw a recovery to 16.6 times. 24 jumped to 59.4 times. And today, 94.1 times. So yes, the multiple is at an all-time high on this chart, but so is the growth rate. That's the key tension, which is why the valuation meter on screen matters. The PS to growth ratio divides the price to sales multiple by the revenue growth rate. Think of it as asking, how much multiple are you paying per percentage point of growth? A ratio below 1 means you're paying less than $1 of multiple for every point of growth. Palantir's ratio is 1.01 times, essentially at par. The signal, priced at a modest premium to its growth rate, not cheap, not egregiously expensive for what it's delivering. The sell side broadly agrees. 13 buy ratings, 10 hold, 3 sell, 0 strong sells, consensus landing at buy. On price targets, the average of all analyst targets sits at $176.33, against today's price of $174.04. The single lowest analyst target is $80. The single highest is $215. You're essentially sitting right at the analyst consensus average right now. No stock gets a free pass, and Palantir's story comes with real risks worth naming clearly. First, multiple compression. A 94 times price-to-sales ratio leaves almost no margin for error. Any shift in interest rates, risk appetite, or growth sentiment could reprice this stock sharply downward, regardless of underlying business performance. Second, competition and disruption. Palantir operates in AI-driven software infrastructure, and that space is attracting serious capital from well-funded players. Any erosion in Palantir's technological edge or government contract moat could hit growth expectations fast. Third, stock-based compensation. Palantir has historically issued significant equity to employees. If that dilution continues at scale, it's a real cost to shareholders that doesn't always show up where you'd expect it. On the catalyst side, first, continued AIP adoption. The artificial intelligence platform is still early stage in penetration. Enterprise and government uptake accelerating could be the next leg of growth. Second, government contract expansion. With geopolitical tensions running high globally, defense and intelligence budgets are growing, which plays directly into Palantir's core strength. Third, commercial revenue scaling. At $2.07 billion, commercial is still smaller than government. If that gap closes, it diversifies the revenue base meaningfully. Fourth, analyst estimate revisions. With 92.8% growth, consensus forecasts have been consistently too low. Continued beats could re-rate the stock higher. So here's where we land. The bull case is straightforward. Palantir is one of the rare companies in the world showing genuine revenue acceleration at scale, with expanding margins, a Rule of 40 score of 103, and a total addressable market it has barely scratched. The bear case is equally real. At 94 times sales, any stumble, a missed quarter, a contract loss, a rate spike, and this stock gets cut hard. That tension is real, and you need to own it if you own the shares. But when you put it all together, the velocity of growth, the unit economics, the AI platform opportunity, the fact that the PS to growth ratio still sits near par, the verdict here is a strong growth buy. This is a high conviction, high risk, high reward position, not a passive hold. Watch the growth rate above everything else. If that acceleration continues, the market hasn't finished repricing this story. Do your own diligence, size it appropriately, but don't ignore what these numbers are saying.